Well, we're about to get started with today's webinar. I'm Allison LaForgia, the Senior Webinar and Events Manager at HW Media, and today our topic is Black Policy in Turbulent Times, and today's webinar is brought to us by Black Knight. A couple housekeeping items before I turn things over to our panel for today. We will be having a Q&A session towards the end of the webinar. You can submit questions at any time by clicking on the Q&A icon at the bottom of your screen. We'll also be sending a copy of the deck used in today's webinar out to all registrants after the webinar is over. That will be sent over with the final recording of the webinar. Now, with that, I'm going to hand things over to Mark Tetris to introduce today's panel and to get started with today's webinar. Mark, the floor is yours.
Great. Thank you so much, Allison. Appreciate that. And welcome everybody to today's webinar. I hope you're going to enjoy it. I'm Mark Tetris, Senior Mortgage Banker and Director of Solutions Specialist here at Optimal Blue, a division of Black Knight. With me today on the panel, we are very privileged to have Doug Frazzini. Doug is Vice President of Capital Markets at Alaris Mortgage in the upper Midwest. He's a 20-year veteran of the industry and a capital markets expert. So very happy to have Doug with us today. And we are also joined by John Dumonso. John is the Product and Pricing Solutions Specialist here at Optimal Blue, and also has more than a decade of experience running the secondary marketing operations within both an independent mortgage banking company and a regional depository. So welcome Doug and John, and we'll kick things off. So I'm going to start a little bit here by just kind of setting the stage of the current environment. Just yesterday, the Optimal Blue mortgage market indices for the 30-year fixed rate conforming top 6%. This is the second time it topped it earlier this year, back in June. And what we're really seeing is kind of just a continuation of the Federal Reserve, remaining hawkish as they're struggling to get inflation under control. They're talking about more interest rates hikes are in the offing. And they are also just now halting their reinvesting in mortgage-backed securities in the open market, and may even begin to pay off some of those mortgage-backed securities or reduce their balance sheet by selling them some of their 2.3 trillion in mortgage-backed securities holdings. So these are pressures that are going to continue to work, against mortgage rates coming lower, and they may in fact even potentially go higher from here, and certainly nowhere near the historical lows that we were experiencing less than a year ago. By the way, that OBMMI indice is available to the public. It's free. It's on the optimalblue.com website. So we'll take another look at some data from Optimal Blue. In this case, we're going to look at the daily market briefing. And in this graphic, we're seeing a one-year look back at new lock volume. It's indexed to a price of 100 in January of 2020. And we can see that lock volume essentially peaked right in September of 2021. I'll just kind of point that out right here, where we were at an index value of 300. So meaning that, basically triple the baseline volume from January of 2020. Volumes overall now are down. If we look out to the right, we're down back to that, kind of index value of 100, which is, a third of where they were. So they've really come down, roughly, let's say about 50% or plus. Rate term refinance locks are down 95% versus a year ago. And even purchase loans are off 30% on a unit basis if you look back to the year ago period. So those and the effects of that, though, are somewhat mitigated by the fact that house prices and values have really shot up in the past year or two. So loan amount and volume on average is a little better, but unit volume has been falling off. So looking a little bit at the impacts of this, of course, I've, have experience having been a mortgage banker myself. I'm sure everybody on the call here understands this, that as rates go up, volumes fall off, especially refis, as we just discussed. And what that can lead to is profitability taking a very serious hit as lenders compete for market share to kind of keep feeding that baseline machine that they built to handle the much higher capacity than is currently needed. And so that starts to cause some disruption in the industry. And so we've already seen, some companies scale back or right size. We've seen some mergers. We've seen some companies exit a channel of the business or even exit the business entirely. And so that's all a result of what we're seeing and is reflected in the numbers that we've got up on the screen. So this is from the Mortgage Bankers Association, their report on quarterly IMB production revenue. And they look at not only revenue, but also expense and come to a net number. And it's really shrunk from, a high of $5,500 of net revenue per loan in the third quarter of 2020. That number's gone negative and is negative to the tune of $82 or roughly 5 basis points on the average loan size in the most recent quarter, which was Q2 of 2022. And just a side note on that, if you exclude servicing income, barely 40% of independent mortgage banking companies were profitable in Q2. So there have been some real challenges out there, and the difference between a profitable and an unprofitable mortgage operation can often be a matter of just a few basis points. And so capturing those basis points, protecting the revenue that we've, delineated at the time of lock with the borrower, those are really the key focuses of our webinar today. And so we're going to get into some of the specifics around that and things that you can do in just a moment. But just to quickly give you a bird's eye view here of, Optimal Blue, the company is really uniquely positioned to observe, the current trends in lock production. We actually, through the Optimal Blue product and pricing engine, locked 40% of the mortgages that are completed nationwide. So we've got a really keen insight there. And our experience of just working with thousands of lenders provides us with a pretty unique level of insight into industry best practices across all different types of originators, banks, credit unions, IMBs, and consumer direct shops as well. So with that, we'll kind of get into some of the nuts and bolts of what we want to talk about today. So and how this is impacting, the secondary marketing departments at our clients and across really all companies in the business. And so let's bring in Doug, as head of capital markets at Alerus and companies prior to that. He has tremendous experience and understands really the pressures that these changing conditions can visit upon, a secondary marketing department. And these are things that are near and dear to not only the capital markets folks, but also important things that loan officers need to understand and be aware of the dynamics of the business. So Doug, maybe we'll kind of turn it over to you to get some of your thoughts on what's going on in the market today and how that's impacting you as the head of capital markets.
Hello, everybody. I think, and this has really been the last 2.5 years. I've been in the mortgage business for 37 years, the capital markets area for 15 of those. And over that period of time, we've seen some of these events where rates change dramatically. And those typically don't happen like 3 times in a 2-year period. So that's created a whole lot of additional stress for capital markets departments, for whether it's your mortgage company or if you're part of a bank. capital structures are hugely important in our ability to get the best pricing, to be able to use a hedging strategy versus just locking best effort, which allows us to gain a little bit more of margin on the sale of those loans. But that all takes money. And when the Federal Reserve came in March of 2020 and aggressively started buying mortgage-backed securities, a lot of us had positions out there that got dramatically affected by them, effectively lowering the note rate on those mortgage-backed securities. We lost $1 million in a day just on a move from 4 coupon mortgage-backed securities. So I think, that's something that out on the street you don't really realize how much of an effect that can have on your business. Those kind of moves will create margin calls where the broker dealers that handle our mortgage-backed securities trading want you to put up an investment of cash immediately to kind of cover your position. As much as we could have benefited by rates dropping dramatically, a lot of companies got put out of business because they couldn't meet those margin calls. They couldn't cover their pipelines with their warehouse banks. So there was a lot of massive impact on that. And you saw a huge amount of production coming in. And lenders at that point in time started margining heavily and I'm talking about your aggregators, your PennyMacs, the buyers of the loans from banks like us or mortgage companies like yours. And that was strictly to slow the production. And what they did, what they were taking in, they had a higher margin on to kind of cover some of those costs. So those are kind of things that drive actual note rates that you get to see on the street. As of the start of this year, we had the completely opposite effect where rates went up 300 basis points or more in a very short window of time. So that, again, caught a lot of people who were hedging. I had $100+ million in the locked and hedged pipeline that was dramatically impacted by that. And I think it really just depends on how your company is, whether you're locking things best effort, you transfer the interest rate risk to whoever you lock that loan with, or whether your company is hedging. Either way, somebody's paying to guarantee that rate. So that's what's kind of driven a lot of our pricing decisions. I might lock a loan today with an expected margin, and 45 days from now, that 6.5 rate is no longer even viable, where somebody does not want to pay because they know it's going to get paid off early. So we've looked at different strategies to kind of offset that, but those are some of the challenges that can really impact the balance sheet and the bottom line.
Great. Well, thanks, Doug. It sounds like you really got to be kind of nimble and ready to move with the market and understand and be prepared for those moves that are coming up. John, do you have anything you'd like to add to this piece?
Sure. I think one of the things that we've observed at Optimal Blue, like Mark mentioned, some changing dynamics in the industry. And so, sitting in secondary marketing, often you're kind of the point person. So for those investor relationships and making sure that you're accessing the liquidity that's available in the secondary market. And so I think it's really important to be vigilant on who's out there buying loans, whether it's, getting feedback from, if you're using a hedge desk, from that desk to see who's buying loans, or just, talking to people, so that you can always make sure that you're setting yourself up with counterparties who are going to be willing partners with you. I think that what we observed for a lot of 2020 and 2021, when everyone had as much volume as they could handle, was really a shift to how can we make sure that we can manufacture this volume as efficiently as possible, And a lot of people looked to technology and leveraging the automation that was available from that technology so that they weren't consistently going out and incurring the variable costs that adding headcount often, results in. I know that everyone heard the stories about, production employees getting huge signing bonuses because there was such a shortage to be able to process or manufacture the volume that was coming in. And so setting yourself up with technology that is able to deliver that automation that can provide scale, I think is extremely important. And then now that we've kind of shifted into the, market conditions that we're in right now, maybe you've gone through that process and set yourself up with a good tech stack. But in order to make sure that you're realizing ROI on that tech stack, make sure that you are in conversation with those vendors so that you are taking advantage of all the functionality that is available to you. I think that one of the things that we've been able to observe or discuss with our customers at Optimal Blue is now that they are, maybe looking a little bit more proactively on what they can do to bring volume in the door. For some, that might mean widening their credit box. And so making sure that they have technology that can accommodate things like non-QM. And again, going back to making sure that in secondary marketing, you're really working with, your network or your relationships to identify partners who can provide liquidity for that and make sure that you're thinking through the delivery channels that are available to you so that to the degree that you can mitigate any potential risk that might come from, originating loans that maybe are a little bit beyond, from a credit standpoint, what you've done in the past. Often those opportunities are out there. You just need to make sure that you are setting yourself up in order to do that. So I think it's been a really interesting couple of years. And I think the people who we've seen succeed are the people who are really making sure that they are attuned to what's happening in the market. They're looking for feedback and they're trying to leverage the tools that are available to them for, in these changing market conditions.
So some really good points, John, and I think we're going to dig into that a little bit more when we get into some of the real nitty gritty here and a deep dive into the lock policy. So today's topic, lock policy in turbulent times, is all about how to manage the new production coming in the door, the locks that are being issued, how to manage them through the manufacturing process to try to minimize any kind of operational leakage that might occur, and to make sure you've really got your policies kind of buttoned up tight, and that can go a long ways towards maintaining initial revenue projections. So before we get into that kind of the nuts and bolts of the lock policy discussion, I thought it might be helpful to kind of level set a little bit our understanding of the true cost of, what does it really take, or what does it cost when we do issue to a borrower a lock-in, or what some of you might know as an IRLC, or interest rate lock commitment. And so, and that is essentially, just to level set, is just a guarantee of that the borrower is going to receive a particular interest rate, at a future point in time, AKA the closing. And so the graph we've got up here actually shows, what that cost might be over time. So there's actually, the daily kind of cost of funds, or cost of capital, if you will, that sort of erodes that day one price. So, when you start out, on day 0 issuing the lock commitment, by the time you get to day 45 or day 60, when you deliver the loan, you would have used up, kind of that capital cost over that number of days. And so it's important to kind of understand what that really means. And what we're showing up here is some fluctuation that we actually have seen as a result of some of the turmoil in the market that kind of hit back in January and kind of started there, and then and then moved on through February and March as rates really took a dramatic increase. And what we started to see there as well was a change in the roll cost. So the ability to extend your hedge coverage from 1 month to the next, and then just kind of dividing that out into a daily factor. And we saw that factor running at around 4 basis points per day is what it would cost in January. So that's kind of the erosion of the price over time, or the time, using essentially the time value of money theory. And then by the spring, it was up to 1.2 basis points. So it went from 0.4 to 1.2. So that's a 3x increase in the cost. So in dollar terms, if you think about a typical $300,000 loan, that price erosion went from $8 a day in January to $50 a day in April. So it really shot up there. Thankfully, it's retreated to around $10 to $15 a day currently. But if you think of that in terms of lock extensions, and what just a 10-day lock extension might cost in real dollar terms, those are some numbers you can apply to that, and that can hopefully help to get you to understand what it really costs when we have to extend a lock versus what we had normally planned on for the expiration of that lock. A couple of topics kind of associated with that, Doug or John, maybe Doug, will start with you, kind of thinking about the importance of bringing in all the stakeholders, the folks that are outside of secondary marketing, to kind of help address this. I mean, you have some thoughts you can share with us on that?
Yeah, I think it may seem somewhat remedial, but I think some of the kind of basics of lock policy tend to go out the window when you're struggling for deals, when you've locked loans and rates have improved, and there's this notion that the borrower can jump and go anywhere and everyone's desperate. So if I try to charge for an extension, that customer is going to leave. And in some cases, that's absolutely true. But in a lot of cases, we just make some assumptions that that's going to happen. And so we don't even ask. And so it really kind of comes back to that partnership of and whatever expectations you set with the customer. If there's a delay on your part and we can't deliver your loan within the original lock period, you're going to have some expenses. It's going to cost you money to keep the rate that you have. And so that kind of starts up front. But I think we just have to be, and I have this conversation every day, when somebody wants to extend a lock and we can't charge the borrower, why can't we charge? I always start with what happened, because we're not in a manufacturing environment that you can't deliver a loan in 45 days.
I think that's sorry, Doug, that's a really good point. I just feel like, you have to have everybody on your side, right? I mean, the processing, underwriting, everybody's got to really be kind of rowing in the same direction to keep on that manufacturing timeline that you set up, right?
Yeah. When your volume is quadrupled in 60 days, it's very understandable that you're not going to make the original lock periods of some of those early locks. But when volume is down 60%, having extensions for no other reason than, we missed something, that's where it becomes very expensive and there's no need for it. Obviously with new construction and all the fun terms you've heard all the last 2 years about supply chain issues and labor shortage, that's all real. And we've had to get pretty creative on new construction. I just looked at one today where the builder was going to fund or close the property in September. Now they're talking about late December or early January. Well, who's going to pay for a 60-day rate extension? They did an extended lock in the first place. They have a rate of 4.25. There's no market for that. If you can't deliver that lock in that original window, you're going to take a 300 or 400 basis point hit just to close the loan. So, and obviously we have to work differently with the new construction. Some builders, who have their own mortgage companies, they absolutely will not negotiate in any way, shape, or form as far as paying them. If it was their delay, they're not going to pay for an extension. They'll just tell them, "Well, come over to us and you can use our in-house mortgage company." So there's some different challenges there. Where we see some frustration is when we lock for 45 days, and for whatever reason we couldn't process that in time to get it closed. The other issue that I always try to remind people of, again, it seems kind of basic, but when you're looking at the difference between a 30 and a 45-day lock in a competitive market, and you have even a minor doubt that you may be able to meet that 30-day window, you always take the 45-day lock. It's very rare that the cost of extending that for even 10 days is going to be less than what you could have gotten on the 45-day lock.
Yeah, and that comes back to that initial,
right,
the initial rate lock policy. That's the key, right? You got to set it up properly, set it up for success on day one, right?
Yeah, especially when rates have risen as rapidly as they have. It just creates a whole new set of problems for us as secondary people, but also from the front end, from an originator standpoint. If we aren't managing the heck out of those pipelines to make sure nothing expires, we're not doing it. Everyone's not, kind of doing their job and being involved in it.
John, what's your take on some of the loan manufacturing KPIs and working with not only the back office, but also the sales organization and how they get things set up?
Yeah, I think the comment that everyone's got to be rowing in the same direction rings very true. And I think that starts with really understanding kind of the essence of, what needs to be done. And a rate lock commitment is essentially a contract with the borrower that you're going to deliver that rate to them. And so, to Doug's point, understanding and making sure that there are clear guidelines on, what are reasons that the borrower's costs might increase and what are reasons why the company might have to incur costs if there's a situation where a lock may need to be extended. I think that, considering, again, kind of current market conditions and the slide that Mark showed where current production revenue is, the phrase that really rings true to me is every basis point counts, and trying to ensure that you're applying your policy so that you can put yourself in a position to capture every basis point that's available to you. And if you need to, for any specific reason, cover an extension cost, you have the ability to very clearly document what happened, why that extension cost is being covered, and that fits within a policy that you've set up so that you have the ability to look back at your production and understand why you didn't meet your day one revenue target on a particular loan. So having Marquez loan manufacturing KPIs, having those and knowing what they are and having the ability to effectively track and monitor those KPIs, I think is really critical, so that if there's a need, for example, for some remedial training, or sometimes it's identifying breakdowns in process, it's usually pretty self-evident what's happening, and the solution as well is pretty self-evident.
That's a good last point too. I think about employing technology to automate and this kind of monitoring process. And I think it's really critical to have, your pricing engine and your LOS and your hedging platform technology all, on the same page. And so having that kind of tight integration so that you've got accuracy and real-time insight into, what stage of the manufacturing process a loan is at any given time, whether there's been changes to eligibility, where you might be able to deliver that loan. It all kind of plays a role in getting to a successful closing and closing on time within the original lock period, so that we can avoid, having these the roll cost and that daily cost of funds kind of eroding the revenue line. So here's this next slide is one we'll spend a fair amount of time on. We've got over on the left side, there's a number of policies. I think, number one is, clarity, as it says here, is really critical to creating lock policies, that are going to work for sales, production, borrowers, and the capital markets success. So I'd like to maybe focus on these, kind of take them one at a time. Here, we've got the initial lock period, we've got extensions, relocks, renegotiations, profile changes, and price concessions. So let's kick it off with a little bit of talk about the, initial lock period, set expectations up front. I think I heard somebody kind of talk about, setting expectations with the borrower that, if rates change, they're not just going to be able to just kind of walk away from what they signed. So I don't know who wants to maybe kind of take a shot at that one first and talk a little bit about, kind of that initial lock period and expectations with the borrower.
Yeah, I can jump in. I think, we covered some of this ground already, but Doug's comment that when a loan officer is working with the borrower to lock the loan, being mindful of what the expected closing date is and what your lock policy is for your firm, so that you can make sure that you're selecting the right lock period. And then if there is consideration that, maybe the borrower is a little bit more price sensitive, and, while I might need 45-day lock on the loan, I'd like to get 30-day pricing. I would rather have the loan officer come to me and say, how can we resolve this, than just try to lock the loan on 30 days, because usually the result of that is the cost of the extension, to Doug's point, is going to be more expensive than the delta between a 30-day lock and a 45-day lock in that example. And I think making sure that, again, the loan officers know that the organization is helped by their communication to ensure that, we're setting the right expectations and the right terms up front. And if there's a need for some reason to, potentially mitigate the, cost of, that additional 15-day lock in that example, often the company is going to be willing to work with the loan officer to do that. But trying to circumvent that is usually just going to result in a bad outcome for all parties involved.
Doug, you want to add any other color to that piece?
Yeah, it's a fairly quick exercise to look at the spreads between 30 and 45. And sometimes it's again, depending on how your pricing is pulled through, if you're using a price engine, different investors have different pricing at different note rates. So if you run purely best X for a specific note rate, you'll get an investor that comes up number one at, call it 6.25. They may not be the best at 6. So you really have to kind of investigate, deeper into the coupon stack, especially if you're offering, the customer different rate scenarios with and without points. So that's one kind of overview there, that there is a pretty dramatic difference sometimes in the middle of those rate stacks for different investors. Lock policy, as far as the cost of extensions, if you're hedging, you typically use probably one of the more restrictive, investors extension policy. If that's 2 basis points a day or 2.5, that's kind of what you build in. So knowing that up front, it makes it easier to do the math. If I'm trying to, lock a loan on a 30-day because I like the price better, but it isn't closing for 35, you got 10 more basis points in there. Now, if the difference is only 6 between the 30 and the 45, obviously so it is basic, but I think it gets overlooked sometimes when we just want to take the best price and hope that we meet the 30-day expiration window.
And I guess the other thing is,
to that
sorry,
is,
go ahead.
I was just going to quickly throw in, knowing investor policy and investor overlays up front can make a big difference in this. I'm in the Midwest, and we have a lot of work escrows, and some investors don't take work escrows. So we've had cases where somebody takes a 6-month lock, collects a point from the customer, and has an extended lock, and we get down to delivery and the landscaping can't be done, or the driveway, and you go back and say, well, we need to set, and that investor doesn't take that escrow account. They won't take escrow accounts. So there's a case where we've even though we've shared the rate risk with the investor over that 6-month period, now we have all the rate risk because we can't deliver it to them. So making sure that the people you lock with are the people that can buy your loan is extremely important in that process too.
That's a good point. You have to be really educated about the product, select the right product and the right investor, and understand what those risks are. So
and I think
that's an important piece.
I think Doug's comment about, from a secondary marketing perspective, understanding the rate lock policies for the investors that you're selling to is extremely critical. And often there's kind of the rule that, to Doug's point, you manage to the most restrictive policy, and also understand, what your organization needs in order to manufacture the loan. So being mindful of what your turn times are from an underwriting standpoint, so that if you know that, again, looking back to say 2021, there's going to be a priority placed on underwriting purchase loans. And so, refi loans might end up getting extended. Well, maybe don't allow lock periods that are less than 45 or 60 days for a refinance in your pricing engine. So make sure there's alignment, and you can mitigate a lot of the downstream issues that can result from that. And then, again, to Doug's point, if you know that there are liquidity challenges for some reason with a specific investor based off of a specific loan product or a specific overlay, even if it technically fits within your guidelines, again, manage how and what you're showing to the originators, so that you're not, again, putting yourself or allowing, the loan officer to unknowingly put you in a position where you're going to have to, take a haircut on a loan, or have something that you're going to have to hold on the balance sheet, or have saleability challenges. So being aware and considerate of those policies, I think, is really critical when setting your own policy.
It's a good point. So let's pivot and talk a little bit about relocks. And I think this is something that hopefully they're rare, but kind of having that policy where you have to make that decision for an expired lock of, now we're gonna continue with the loan, and we have to evaluate, is it going to be worst case, or is it going to be current market pricing? What are you doing in terms of policy around that, Doug?
Again, it's very, we've laid that out very specifically up front. The message is obviously and I guess we're going to get to renegotiations next, so I'll stay out of those weeds right now. But as far as relock goes, you've got, again, probably managing to, if you're in a company that's hedging, so that you may pick a price from one investor, doesn't necessarily mean that's the investor that buys the loan at the, when it's time to be bid out. So when that's the case, then you have to go back to that kind of most restrictive policy. So we tend to, somebody like Wells Fargo has a very easy relock and float down kind of operation within their website. And I think people kind of get used to that, and that's kind of the gold standard, but they do 20 times 1,000 times the volume most of us do, and they can bear those costs a lot easier. They have economy of scale that we may not have. So we really have to look at, on a relock, we're going to have that 30-day window, from the date of expiration out 30 days, you're going to have worst case pricing on the 31st day, then you'd return to market.
Gotcha. So why don't we go ahead and kind of plow ahead with renegotiations then, and kind of talk about that a little bit. And, we've got a kind of a sub note that it's kind of a device of last resort, but, it is a reality, and things happen, and, markets change, and we need to be able to deal with those. And having a policy up front, I think, probably helps, to navigate those things more effectively. What are your thoughts or some tips you might have around renegotiations?
John or me?
You take your pick. Go ahead, Doug. I think you were headed that way. So,
well, yeah. When you say the device of last resort, we're not we're not living in a cave here. We know that if rates are dropping 0.5%, 0.75%, whatever, you're going to have customers coming back to you. I try to hammer the message home that we don't sell renegotiations and float downs unless you've locked with a specific investor who offers that. So we're not going to, in a negotiation process say, oh, well, we could do a float down. That just sets you up. And a lot of times the terminology becomes muddy when, between you and the customer. When you say we can float you down to market rate, you're not doing that. There is a cost associated with a float down or a renegotiation, and that has to be borne by someone. And it's typically built into the pricing. So we try to estimate or say your pricing from the date of lock to the day you're looking at a renegotiation has to improve by at least 0.75 points. And the customer has to have at least 0.125% benefit to lowering the rate to make that worthwhile. You never make more premium on a renegotiation. So that's kind of the premium that was associated with the original note rate is set. And then that's where that say it's 0.75 points comes into play. It has to drop at least or improve by at least 0.75 points to absorb, say, a 0.5 point renegotiation cost. So you can kind of look at those and see what's available for a renegotiation and what's not. If you're a best effort shop and you're locking with specific investors, obviously we have to go to the specific investor's policy. And what never happens is market rate. So you have a customer that has been locked for 45 of the 60-day initial lock. Your lock renegotiation calculation is going to be based off a 60-day price. They're going to be looking at or talking to a desperate lender out there, just ran into this yesterday, who's going to, offer a 30-day price or know that you're closing in 15, they're going to offer you a 15-day price. So you're never recouping the actual cost of that renegotiation. And the other thing we touched on in the beginning, premiums for specific note rates change dramatically. If rates are improving, obviously a higher note rate is less valuable. That it's going to pay off sooner than the lower note rate, so it becomes less valuable to the aggregator, to the person buying those servicing rights. So we may have had a set premium on day one of the 60-day lock. It may be vastly different for lower note rates, that 45 days later. So those are just some of the things that you don't probably think about that impact somebody's renegotiation policy.
It sounds like, so you really need to have access to all the data in real time to kind of make those decisions. You got to do the math real quick too, right? To make that, to make that work. John, any other comments on renegotiation?
I think Doug covered it really comprehensively. I think the continued reiterating how important it is to have that policy set up front allows clear lines of communication between the borrower and the loan officer and the secondary marketing desk.
Yeah, I think these next two, if we can move to those, profile changes and price concessions, they kind of tie a little bit together as well. So maybe we talk a little bit about profile changes. What are some thoughts around that from a policy perspective? And I think that's going to kind of lead right into price concessions. John, you want to kick off on this one?
Sure. So when we say profile changes, we're thinking about changes to the loan characteristics or to the loan terms that occur after the initial rate lock throughout the origination process. I think we've observed that changes to loan characteristics happen on pretty much every single loan as it moves through the manufacturing process. And if you don't have a policy to manage to those changes, as a company, that's an area where you're potentially putting some of the revenue you're staked to make on that loan at risk. Often that is the byproduct of, differences in risk-based pricing adjustments. So as loan characteristics change, it's important to make sure that you have the ability to reprice the loan to the current loan characteristics so that when you are in a position to deliver the loan, you're able to capture every single basis point that's available to you. If you're not doing that, what's going to happen is when you deliver the loan, the investor is going to make sure that they're pricing the loan to those the current loan characteristics, and there will be a pricing discrepancy that will result in operational leakage. So making sure, again, you understand the lock policies of the investors that you're selling to and how they treat those changes is really important. And then if you're using a pricing engine, having a pricing engine that can accommodate repricing loans and can apply your policy or can even pass through an investor policy, I think is critical to mitigating the operational leakage there. I think another thing that's really important is that as loan characteristics change, we're also beyond just the potential pricing impact of those characteristics, there's also potentially an eligibility impact. And so being able to ensure that as those characteristics change, you're constantly rerunning the eligibility to know, is the loan still saleable with the current product? And if not, do we have the mechanisms available to identify any other loan products that might be available that we can switch to? And then obviously managing the pricing impact of that, including historical pricing, is really critical.
So some great points. Doug, what are some of the things you could share from your experience kind of creating lock policy around profile changes and price concessions? How do you guys handle it?
Well, I always like to give real world examples. So we hedge all of our conforming and government production. So obviously using a price engine and an eligibility engine up front, removes a lot of those issues, but it comes down to the old computer adage, what gets garbage in, garbage out. So you have to be mindful of the parameters that you're using when you're pricing a loan and locking that loan, that those are the same parameters that you're going to fund and close and deliver the loan with. I had two that came back where the purchase advice came back 30 days later, where a loan was locked as a home possible or a home ready, and processed through the system at some point was closed as not a home possible or home ready. And in both of those cases, there was a dramatic price swing, and it impacted our purchase advice by negative $7,600. So somewhere along the line, even though you had your findings and it said whatever it was that kicked you out of Home Possible or Home Ready, be it maybe they put more money down and the LTV removed those price adjusters. If you're using a price and eligibility engine to lock your loans, then there's a whole process to do profile changes that will adjust the pricing for you in that real time, just as John was saying. In this case, slip pat underwriting should have cross-checked that to make sure that the lock that's in the system matches the loan that they're approving. That would have stopped that, and they would have forced a profile change. We have our system set up, and this is slick because then you're not relying on a secondary desk to have to confirm the changes to the lock. We use an automated profile change when there's no price impact. So you submit your profile change, the system recognizes that the parameter changes don't affect pricing. It just automatically updates your lock with the new profile and re-imports it back. In our case, we use Encompass. So that's slick, and it's a very efficient way to manage those, and it can be done after hours. And so I really like that tool. Then if it does affect price, then it kicks into our secondary queue, and our lock desk coordinator will then process that. So, but we need the people up on the sales front or processing to be mindful of that. If an appraised value changes or a sales price changes, even if it changes the loan amount, we know that the way loans are priced now, you can have a pretty vast difference between a loan at $220,000 versus a $500,000 loan. And so small changes, it's priced a lot like mortgage insurance is. Very small changes in the parameters of the loan can affect the pricing, whereas that didn't used to be the case in the past. So those are the kind of things where we can manage and protect the original expected profit on that loan.
I would always tell people, don't assume that it won't impact pricing. And I would rather have you reprice the loan and we just find that it has no pricing impact than assume that it doesn't and not reprice it and then find out downstream that it does. Another thing that I think is an important consideration there is the timing of repricing the loan relative to when the change occurs. With a 3-day disclosure window, that can create bottlenecks. So making sure that you have some sort of a procedure or policy in place so that, you know, let's say an appraisal comes back and there's a change to the appraised value, or the appraised value is different from the expected value and it affects LTV, be able to reprice that loan right away so that you as the company are in a position to issue the redisclosure and maintain compliance or saleability, as well as maintaining your margin. So I think that it's important to think through, you know, kind of the mechanics of how that works and make sure you're mindful of that 3-day disclosure window for those changes.
And that's another good point, is compliance is another department that we always have to kind of coordinate with to make sure that we're all rowing in the same direction, as we said earlier. So let's pivot over to spec pay-ups and talk a little bit about those. And spec pay-ups, for those who may not be completely familiar, are the additional premium that many aggregators are willing to pay for loans that have certain characteristics. The most common being lower loan sizes. And the reason for that is that the lower the loan amount, the less likely that loan would be to prepay in the future, primarily due to the fact that closing costs are going to be proportionately higher dollar number relative to the loan amount. And so getting to a point where it makes economic sense to refi takes a bigger move for a smaller loan balance. So they tend to stay on the books longer. So the servicing, the revenue stream is more certain, and then it'll last for a longer period of time. And so bringing that into, kind of current cost of funds status, allows the aggregators to pay a little extra premium for those smaller loan sizes. And so, but what's interesting though is that it's not a fixed number, and so those things change based on market dynamics. And you can see up on the screen here, I've got a bit of a heat map that kind of shows the 1 month change in spec pay-up values from March to April of this year. And the reason for putting this up is just kind of illustrate and help us to understand that there's something referred to as basis risk. And in other words, the value of the spec pay-up will not necessarily maintain the same relative value to the note rate or loan size over time. And in our example up here, if I were to look at, let's say this 4.25 for $150,000 loan size, on the screen here, I'm getting a 53 basis point pay up movement to the negative. So what that's telling me is that originally that loan with a balance of less than 150, in March, I would have gotten 126 basis point additional premium for delivering that loan size versus the standard loan size. And so if I were to pass through all of that premium on my rate sheet, then the issue that arises is that down the road, when I go to sell the loan in April, and if that pay up has deteriorated, and now I'm going to sell it, but there's only 73 basis points of pay up, that's where I would have lost 53 basis points to that spec pay up change. So I think it's important that we think about that and maintain a conservative posture when it comes to the concept of passing through all of that spec pay up value to your rate sheets. So something to be mindful of. And so if you're on the secondary desk, something to think about. Another thing is to always be diligent about monitoring for any investor axes. So sometimes a particular investor will come into the market, and even sometimes on a best effort basis, will really put a premium on because they really need loans of a certain size to fill out maybe some CRA requirements they might have. And so being able to look for those and perhaps even then lock those on a best efforts versus a hedge basis would be one thing to consider in your overall strategy. So you can see we're getting close to the top of the hour. So I'm going to move maybe a little bit more quickly here. We've got the best efforts to mandatory. A couple of highlights on this. I think John, maybe you wanted to hit a couple of highlights on this graphic for us.
Yeah, I think we've covered a lot of this territory already, but I think that the biggest takeaway is that ultimately, if you're delivering mandatory, it does give you more flexibility as an organization to manage to these different things. If you are delivering best efforts, I think it's really important to be very mindful of the investor lock policies. And if you're trying to be margin neutral for a lot of the stuff that we talked about, make sure that you are applying the investor's specific policy to your lock pipeline.
Terrific, Doug. And I can give you the last 45 seconds here to opine here if you'd like to hit any of these points or anything else from our conversation today.
Yeah, I think we kind of touched on a lot of these. Again, some of it's kind of specific to how your production environment is set up. But one thing I've noticed is people, lock policies are pretty standardized and they haven't changed a whole lot over the years. So just because rates went up 300 basis points doesn't mean that the lock policies have changed. So you can't move a lock from one property address to another because the deal fell through. I get asked that, and it's a lot of times by seasoned originators, the same kind of things that have always applied. So knowing your lock policy is very important.
Okay, cool. Thanks, Doug. So I'm going to just kind of, just in conclusion, and I'm sorry, I think we talked right through having the Q&A, but we did capture the questions, and so we will respond to everybody offline. But ultimately, we're seeking to protect pipeline profitability in our volatile market. And it really just is a matter of kind of the old Boy Scout adage of being prepared, maintain a somewhat conservative posture, do your diligence, and use automation and the tools available out there to help with, doing the math and doing the analysis of when to, pursue a certain policy or decision-making tree. Operational efficiency is paramount and requires collaboration amongst the various departments that you're working with. And just communicate expectations, I think, can go a long way. So with that, I think we're at the top of the hour. I'll turn it back over to Allison for the conclusion. And I do want to thank panelists Doug and John for being on with us today. I appreciate all the insights.
Thank you.
Yeah, thank you, Mark, John, and Doug. And unfortunately, we are out of time at the top of the hour for today's webinar. If you submitted a question to the panel, we will be passing over all of the questions and you will be able to get answers afterwards. We will also be sending out a copy of the deck that was used in today's presentation with the recording in the next few days. This webinar will be available online at HousingWire.com on our webinars tab. So if there's anything you want to go back and watch again, you will be able to do so later this week. Thank you all for joining us today, and hopefully we'll see you all again soon.